Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending June 18, 2021. And as usual, I'm joined by our chief economist, Clément Gignac. So good morning, Mr. Gignac.
Good morning, Sebastian.
All right, I'll start with the economic overview, and then I'll hand it over to you to dig into the markets. But before, I'll just look at the market action this week at the close on a Thursday. So as you can see, some black, some red on the screen. But the important story this week was the Fed. The Fed changing its tone a little bit, and the impact on the U.S. dollar was very strong, a positive impact on the U.S. dollar, and it's all over the returns here. So first, bonds were a bit positive on the week as interest rates moved a little bit lower following the Fed. Mr. Gignac will be discussing that. It's not all of the rates, but the as an aggregate positive on the week. Returns on equities were mixed, but when you bring everything back into Canadian dollar, because the US dollar was so strong, your Canadian dollar was pushed lower. You were very well rewarded for being invested outside of Canada on the week. Oil was flattish, but Canadian dollar down to 1.6% versus the USD, minus 1.7 for the euro, and gold was hit a bit harder, minus 5.5% on the week, and below $1,800 for gold. So very eventful week, and we'll dig into that in a few minutes. But first, let's start with some good news. Canada now we're number one in the world in vaccination, so good reason to be proud here. As you can see on the left, the trend remains very positive for Canada, which is the red dotted line. So the pace remains very strong. We are ahead of Israel here, and you should expect the data to be even better and better as we move towards the end of the summer, because Canada is now in the strategy of even moving forward the second doses for its population. So expect the light shaded blue part of the line on the right hand chart to move to take over the darker one as we move towards the summer. So very positive. We are reopening the economy, and it could be sustainable with this kind of vaccination performance. China now, it's been a while since we've discussed China, but probably we'll be talking about it a bit more in the coming months. China now is really looking to tame inflation and producer prices. So this is the PPI on the left. It's about at 10% right now, and as you can see, the trend remains very positive. So we're trying to attack that. And on the right, it's the ferrous metals, minings, and processing. So lots of hoarding of commodities in China, speculation around the strength of the global recovery. So 50% rise in the price of metals in China. So China is looking to deliver slowly to attack these prices, to attack the strength of the economy, to make sure that we do have a sustainable rebound and not and not have a boom bust kind of cycle in China. This is starting to show in the data. On the left here, you have the industrial production. It's still a very healthy level of growth, about 9%. But as you can see, we are starting to fall from very elevated levels. So probably we're looking at peak momentum here in China. That doesn't mean that we're peak economic activity, just peak momentum slowing down. Probably we'll see the PMIs around the world start to move down slowly, but from very elevated levels. So this could bring some volatility to the market, or more volatility to the markets until the end of the year. So something definitively to keep our eyes on. On the right, same story, but with retail sales. So China is in a deleveraging process, could have some global impacts. Canada, we are seeing inflation accelerating here too, but less than in the US, 3.6%. There's the base effects that takes a part of that, but still month over month, we're seeing some strong acceleration. Of course, we are less far ahead than the US in our reopening process. So that means that we have less price pressures on some key sectors, but expect inflation to stay in Canada as much as in the US for the next few months, probably less so, but still the inflation story that we have in the US will apply to Canada. Talking about inflation, we had the Fed coming this week a bit more hawkish, surprised the market a little bit, but here focusing on their forecasts, you have the GDP forecast, unemployment rate, PCE, inflation, and core PCE. As you can see, between March and June, there was quite a big pickup in their forecast for GDP growth in 2021, went from 6.5 to 7%. So that's a strong revision there. And the other two red circles that you see, it's inflation. They were expecting 2.5 2021, now 3.5, and they're seeing upside risk to their inflation calls. So the Fed is looking at the stronger prospects than it expected. That means more inflation than probably they expected. So that means probably they'll have to tighten sooner than expected. So this is what created the movement in the markets this week. But they were especially positive on the labor market. One of the indicators that they like to follow is the quit rate. So the number of U.S. workers leaving their jobs as a share of total employment. So up 2.7%. We're hearing stories about key employees in some key sectors that are being poached and just moving from one job to the other to get better conditions. So this is pushing the jobs rate higher. Usually you see that at the top of business cycles, not at the beginning, but this is a very peculiar economic environment that we're seeing here, and the Fed is trying to navigate through that. And that brings me to you, Mr. Gignac, financial markets, the Fed, the volatility. So lots of things to discuss this week.
Yeah, thank you, Sebastian. Hello, everyone. So definitively, if investor thought that it will be an easy summer and just enjoy the ride, oops, maybe Mr. Powell have decided that it will be a little bit different. So just following what you have mentioned, Sebastian, the first slide, we talk about Mr. Powell that he delivered a much more hawkish statement, and then or it was a hawkish surprise, basically. So it was interesting because the press release at 2 o'clock talked mentioned more or less nothing, okay? But the press conference was quite different because suddenly no longer talk about inclusiveness in the job, not refer too much that 8 million people less employed than before the pandemic. No, he talked about the strong labor market twice rather than once, and he is less convinced about inflation. It's just only transitory. He opened the door that maybe, just as Jimmy Dimon, the CEO of Citigroup, has mentioned, that inflation could be more resilient and could be higher and stay for longer than expected. So he basically edged himself, okay, not to be put in the corner. So he had decided to open the discussion, and clearly I think that have an impact on the market. On the next slide, we show, in fact, the dots. Keep in mind that the dots is the survey among the Fed governor before the meeting. Okay, what is your expectation of a rate increase? So even before the meeting, the majority of in fact, of the Fed governor expect interest rate rise before 2024. So in 2023, that include two rate hikes, and even now seven Fed governor expect in fact, rate increase as soon as the end of 2022. So it came as a surprise. Huh? So you can notice on the right side, the probability to see Fed hike before the end of 2022 suddenly spike to 90%. So was a shock. And they have an impact on the bond market as well. Notice on the next slide, we present what happened to the 5-year bond maturity. They have jumped by 10 basis points in one single day. and this is among the top largest 5 year sell-off ever seen in a decade. So that tells you something. So clearly, a lot of people was short on the bonds, and they was taken by surprise by that. And not only that, now the market expect that the Fed will pull the trigger and increase interest rate before, in fact, 2024 and even 2023. But even the QE, the tapering could occur, the beginning of the tapering could occur faster. People until recently thought it was only the beginning of next year, but be ready that it could be as soon as this fall. We will have a Jackson Hole meeting with a lot of central banks. It's an annual meeting, Jackson Hole in August. So probably be ready that you have a synchronized central bank who could decide to remove the liquidity. So the market could become really nervous. Reason, next slide we show it to you, is because keep in mind that on the bond market, people been underweight big time, and now they could be taken by surprise if you have this kind of situation. So clearly, on the stock market, not ready necessarily to have such volatility on the bond market. So on the next slide, we show that this correlation, this is a 2 decade high, the strong correlation between now the stock market and the bond market. So if the bond market become more volatile, be ready that you will have more volatility on the stock market, because you know the market, the S&P 500 trade at 22, 23 forward earnings. So it's not really cheap. Uh, Make no mistake, we do not see a bear market. We do not see any 20% correction, of course, because earning will be strong. If economy is good, earning will be strong. But forget P expansion. We are no longer in the P expansion, and it's a possibility that some people will remove some chips because that could create some volatility. So we have seen a lot of rotation. It was the reflation trade that we have seen the last 6 months. So if you combine a Fed more hawkish combined with China, who want to attack the speculation commodities and deceleration of the credit growth, it was the perfect storm for the Canadian dollar, for example, and other commodities currencies. A lot of weakness that we have seen in the last few days. So do not change my mind over the long run that the Canadian dollar has further room to appreciate, because the Bank of Canada will probably put the trigger before the Fed. But having said that, we be prepared that you can see a little bit further weakness on the Canadian dollar. TSX as well, commodities could be affected. So it's all about this reflation trade. So that's the reason that, in fact, we have scaled down our optimism on the TSX, but we think that over the long run, we still have a huge potential. They trade only at 16.5 times forward earnings rather than 22 times in US. But nonetheless, be ready that whatever is Wall Street or B Street for some volatility this summer. We believe it will be buying opportunity because we do not see any recession anytime soon, and interest rate will remain low and for the next 2 years. But clearly, they have some hype to remove to the market. So I was a little bit long, but we have a lot of things to watch next week, Sebastien.
Yeah, sure, we do. So we have the retail sales in Canada that should be falling 5% month over month in April. Remember that kind of a stop and go on the reopening, and with the new waves, we had a bit of a shutdown of the Canadian economy in April. So weighing on retail sales. Other than that, in the US, we'll have the market, manufacturing and services PMIs. Both should be a bit lower, but at a very elevated level. So as I said, maybe peak momentum here, but still some very strong growth ahead. And GDP growth revision, first revision that we have, should be stable at 6.4% in Q1 for the US GDP. So as usual, ia.ca is your go-to web page. Everything that we post there is available, and you can also subscribe to the newsletter if it hasn't been done already. So thank you everyone for following us on a weekly basis. Thank you very much, Mr. Gignac, for your insights.
Welcome, and do not forget in Quebec it's a holiday next Thursday. And since I will leave for 2 weeks for my summer holidays, so it's possible that you will be alone, my friend. But we will have an opportunity to catch up. So this summer we continue the weekly capsule, but
Mhm.
from time to time it will be Sébastien alone or me alone. But we'll continue to serve you. Okay, have a
Yeah.
nice weekend.
Yeah, thank you. You too, and everyone out there, enjoy the good weekend, and we'll be back next Friday with another edition of the Weekly Economic Review.